All right. Thank you to everybody that is joining us today. This is 10 Capital's very first investor intro session. We're happy to have you. We would love for this to be, as interactive and as informative as possible. So we welcome you to turn on your video and your audio. We want to make this conversational. If you have questions, just let us know. If you're not comfortable turning on your video today, that's fine. Just drop your questions in the chat box and I will moderate those for Hall, who I would like to introduce now. Hall T. Martin is the CEO of 10 Capital, and he will be leading the discussion today. Hall, if you want to get started, I will pull up your slides.
Great. Well, thank you guys for joining us today. Like Ashley said, I want to make this interactive and answer any questions you have. I'd like to kick off with a little bit about 10 Capital. We help startups and investors connect for funding. We've been doing this for 10 years. We originally started under the name Texas Entrepreneurs Network back in 2009 when we started, and have rebranded to 10 Capital about 4 years ago when we went national with our program. And so today we're going to talk about how to invest in startups and make a predictable return. And so to kick off here, let's go to the next slide. My background is I started angel investing back in the early 2000s, and in 2003 I invested in a startup. I put $50K into an Austin company, and for the first 3 years the company grew rapidly, and then at year 3 it plateaued. And I remember when they did that, the CEO came to me and said he wanted to take all of the employees and take them to market rate salaries because they worked so hard. And when he said that, I had tremendous cognitive dissonance going on, because at the surface it sounded right. If they worked hard, they should get paid market, but there was something wrong about it. I took a step back and looked at it, and what I realized is that in the startup world, there's an implicit agreement. The CEO is taking below market rate salaries to make the exit as big as possible, and the investors are not taking out profit share or dividends, again, to make the exit as big as possible. When the startup goes to market rate salaries, that means they're no longer on the venture track. They have now left that, and they're on what I call the payroll track. And they're going to be taking their exit in the form of salary. And unfortunately, the investors are not on salary, so we're not participating in that as well. In that company, 7 years later, after they went to market rate salaries, they sold the business. And the investors on that case got a 50% return on the money. So I put in $50K, I got $75K back. After 10 years, I got a $25K profit. If you do the IRR on that, it's 4%. And the company, the CEO and the other C-level people, I estimate over the next 7 years when they did that, they took out almost $3 million in the form of salaries. And so $3 million versus $25K, what's wrong with this picture? There's something wrong here with this structure. And so at that point, I decided, to look harder at startup investing. So if we go to the next slide, I wanted to say, first of all, there is a concept around time value money that all investors should be looking at. ROI is return on investment without respect to time. IRR is return on investment, but with respect to time. So if we go to the next screen, if I invest $50K and 3 years later, I get $150K back, I've got a 44% internal rate of return, but it's a 3x ROI. If I get that same 150K back, but 5 years after I invest, my ROI is still 3x, but my IRR is now 25%. It's much less. And so you want to talk in terms of IRR, because it more accurately predicts or measures the return, because it's taking into account the time you're in the deal. So if you're in the deal for 10 years, you get 25%. 50% of your money back at that point. It's a 4% IRR. It's not very good in that case. So if we go to the next slide, the challenge.
Andrew had a question. Where was the board you were speaking of?
The board?
Maybe Andrew, if you could clarify or turn on your audio for us.
Yeah, when you got screwed, where was the board of directors? Why weren't they shooting the management?
Again, another mistake in this case is there was no formal board of directors. There's only an informal board of advisors in this case because it was an LLC and it was not set up to be a C corporation. It was not set up to be a formal board itself. Having said that, I will tell you, I've seen many, many startups with a formal board of directors, and the formal board of directors becomes complicit with the entrepreneurs. They don't hold them accountable. We've missed our third plan, but we're going to give them a fourth shot at it. We want to support these guys, but we're really not going to hold their feet to the fire. We really want to see them do better, but we're not going to hold compensation according to the results. So even with formal board of directors, I found that many times they fail to go through and actually achieve the the performance that you would expect them to achieve. So you cannot always count on the board of directors to come through with these things. So any other questions? Okay, let's carry on with the next step in this. If you look at historical returns for startup investing, I think you'll be familiar with this. Out of 10 investments, one is a home run. It's 10x plus. It's great. You may have to pay some taxes on it, but you did well. One of those companies goes bankrupt. You get a tax write-off, but there's no return. 1 to 2 companies out of 10 are singles and doubles. You get 1.5 to 3 extra money in most cases. So there's some taxes to be paid there. And then 5 to 6 turn into lifestyle businesses. And this is what most people don't talk about, is the deal that just never goes up and it never goes down. It just goes sideways. And this is, I found, the one that you avoid at all costs because there is no equity return, or much of any, like I had at 40% IRR, but there's also no tax write-off. You're in this deal for 10 or more years and your money's caught up and there's nothing you can do. And so this is the problem we're trying to solve here. In most cases, people are trying to find the 1 out of 10, that home run, and they're trying to avoid the other 9. So it's a challenging game when you define it that way. So if we go to the next slide, what you'll see is that we've done some research, and this comes from Crunchbase, and out of 1,000 seed fundraisers, only 400 go on to raise the next round at Series A. And so that means 60% of all startups being funded are off the venture track after the first round of funding. And by that, I mean they're no longer raising funding, they're no longer growing, they're no longer making their way to that multi-million-dollar exit that was discussed at the beginning. Ultimately, only 16% of all startups ever are acquired. And that means 84% don't ever make it all the way up that curve. So it's, again, a challenging prospect to find that 1 out of 10 in what we're doing. So if we go to the next slide, what we're trying to do now is redefine the game a little bit, because once in a while you come across a 40x return. That's great. It pays for everything, but you have to sort through a lot of companies, go through a lot of failures to get there. And so the idea is to redefine the game and look for and invest in the 9 out of 10 that are not going bankrupt. They're up and running and they're successful. They're just not venture successful. They're just not 40x successful. And structure the terms to get a return that lets you work on that. And so based on my experience with startups, I came up with this model and have used it before and want to share it with you today. If we go to the next slide, what you need to do is come up with your own term sheet and include redemption rights into the deal, and then watch what the company does. If the company goes on the venture track, stay with them on the venture track. If they go on the payroll track, you set it up so you can go on the payroll track with them as well. And so what I came up with was a 3x return at year 3. It's a redemption right inside a convertible note that it gives the investor the right to convert to debt or stay in debt and use a redemption right to get paid back, or forgo the redemption right and go on the cap table for your original investment as you acquired. So at the very beginning, when you invest in a startup, it's hard to know where they'll be 3 years down the road. But in 3 years, so I want to make my decision at year 3 about which way I'm going to go. I'm going to go on the debt track or the equity track, but I get to delay that decision for 3 years to see how the company performs and see what they do and where it goes. The only drawback is if the company does go under, you do lose all your money. So there is still a risk in this game as well. If we go to the next slide, we can see that let's go back one. And, some of the key facets of this are let's see, let's go back one, two more, and then look at some of the elements of this term sheet. And so it's at investor sole discretion. Every investor makes their own decision. So 3x payout, if they can't pay out at the time of redemption, they go on a revenue share agreement and they pay sometime thereafter. Investors have control over all cash disbursements during this time frame, so we make sure we're staying on the track to get paid out. And I've come to believe that if a company can pay salary, they can pay the investor something as well. It may take longer to pay out, but they can do so. And if you do get 3x in 3 years, it's a 44% IRR, which is in startup investing. That's the range you want to be in for the risk you're taking, because again, not all of them will be able to pay out. Some will go under and will go bankrupt, and that's part of the game. So if we go to the next slide, some people say, well, I really want to go get a 10x return. And so if you look at it from an IRR point of view, 3x in 3 is a 44% IRR. If you have 10x in 10 years and you get 10x after a 10-year window, it's a 26% IRR. And if you want to get back to 44% like you had with 3x in 3, after 10 years, you need to be looking at 40x returns. I've seen those happen. In the last 20 years, I've seen about 4 of them. So they happen about once every 5 years, you'll get one that does that. So they do exist, but they're really not the norm, and it's really not something you can count on consistently. 3x in 3 is something you could count on consistently, deal after deal in many cases. So let's go to the next slide and see. So the objections I get of this is, number one, that's against the rules. We're all supposed to be on the venture track. And one of the things I find is that venture economics is different from angel economics. In the venture world, they bake their salary into the fund. They've got a 2% management fee and so forth that requires them that if they don't, every deal has to be 10x return or more, because otherwise they won't be able to pay back on the fund returns that they promised. So the venture economics does push people into a place where they really have to have 10x. In angel economics, where we don't bake our salary in, we don't have to get 10x to still make a decent return. We can get 3x in 3 years and still make a good return out of it as well. The other feedback I get is, well, no startup will accept that. Well, I have many startups that will accept that. In fact, about a third of the startups that come in are hoping the investor takes the 3x and leaves after year 3 because they don't suffer dilution. They get the equity back and they get to carry on. And for some investors, that's the right answer. I'm in for a certain amount of time, 3-5 years, and then I'm out and I can go on to my next deal as well. So there are many startups that will accept that. And then the third one is startups can't pay back. And I think the misunderstanding is that in 3x and 3 doesn't mean you're going to get all 3x your money at year 3 in one day. If you decide, that's usually not the case. These are businesses, they have to cash flow, they have to continue running. And so what I coach startups is that you want to escrow money to pay back the original investment at year 3, and then put the rest on a revenue share payout plan as well. And it may take longer, but still there is a path out of the deal in case it's not continuing on the venture track like you had hoped. So with that, let's stop and see, are there any questions people have?
Yeah, Andrew was actually wondering if there were moral hazard problems with this.
Yeah, if an entrepreneur feels that they won't be able to pay back that, then don't they have an incentive to kind of gauge in opportunistic behavior to basically get as much as they can before the deadline comes due? Take suboptimal investment decisions.
So, there is that case. And one thing I always make clear is we need to be negotiable with the entrepreneur. If it takes longer, we can take longer as well. And so it's something that is not cast in concrete that they, have to pay at 3 years in one day. We can come up with other solutions. The other thing that comes with this, and it comes from the revenue funding world, I don't know if anybody's done revenue-based funding, but you don't just sign the contract and wish them well and then come back 3 years later to see how it worked out. And many angel investments are like that. They write a $25K check, and then they, 3 or 5 years later, they'll go check in to see what happened to it. This is the case where you actually get in there and work with them. In fact, we have a facilitation agreement where we go in, and with the startup, we have access to the bank account and to the accounting system, and we see what's going on. Are they escrowing funds? Are we growing? Are things the way we think they are? And we get the information reports out of it that we are entitled to without having to bother the startup. We can run income statement and balance sheets, and we can watch what's going on there. And if we're promised certain things, we can tell what that looks like. And then if we see that it's not lining up with what we thought it was or what they're telling it is, we can have discussions along the way about that decision-making process as well. So I find in most cases, the company is very important to the startup. It's how they're getting their payroll. It's how their careers lined up. And for those who are tied to it, they're not going to throw it under the bus. They're going to keep it and then start working or negotiating a way to take care of the investors as well. So we always have to be working with the startup. We can't be working against them in that case, but we do check. We do look to see how things are actually going on, because I've had people tell me one thing, but another thing was actually happening, and found that to be very troublesome is the way I put it.
Do you have literally a backdoor into their accounting system, or do you insist on weekly reports, or what?
You actually have a login to the accounting system, and so you get to view everything going back and forth. And one benefit of that is we don't have to go and ask them what's going on. We're able to take monthly or quarterly because we have information rights, we can take usually it's the income statement, the balance sheet, and the cash balance, and we're sending out to the investors saying, here's the current status of the business. And you can see over time. And actually what we're really checking for is, we should be escrowing some money for this. Are we actually doing that? And that may not be in the first 6 months or whatever, but in years 2 and 3, we should be escrowing. And then if we ever have any questions, we're talking with a knowledge of the history of the company itself. And then we're seeing if it's really on the right track there as well. Because again, in many cases, the investors don't take the full 3X in debt. They often take 1X, and the rest goes on to equity because it's a good business, and the equity exit will be bigger than the payout of 3X. It'd be 5, 10X. And so it's not guaranteed that you're going to have to pay out all 3X. Up front. It's when it turns into a lifestyle business and we're making a decent salary for the two of us here, but no one else is going to get paid back. That's what this is meant to be. This is meant to be a way to have a way to come out, because if you ever try to negotiate a redemption right after you sign the check, you'll find that to be very, very hard. You're on the one side as an investor thinking, oh, I'm going to get 2X my money, 3X my money, 4X. They're on the other side thinking maybe they'll be happy with 20% return, 30% return, 40% return. And to meet in the middle is very, very difficult. So it's best to put the redemption in up front, and then everybody knows what the price is, and then it can go from there.
Thanks.
Sure. Any other questions from anybody else? Any feedback? Anybody think this would work for you, or if you would use it in your own deals?
All right.
Cool. Any other questions, Ashley?
Yeah. So what exactly does investor sole discretion mean?
That means the investor gets to make their election choice all by themselves. We don't have to have a majority. We don't have to have consent from anybody else. If I want to go all 3X, I can. If the person next to me wants to go 1.5X, they can. And one thing I find is that these things really are not always just, I either take 3X or I take equity and there's nothing in between. I've seen people take 1X their money out and the rest goes for equity. 1X. I've seen other people take 1X their money out and the rest goes for debt. I've seen people split it half for debt, half for equity. And you have to think again about the realities of the situation. If there's not enough cash going on there, it's probably best to take out less in debt and leave more on equity if you want. Just to, at heart, you want to help the business and work with them, but you don't want to just be in the deal with no return at all. 1x return at year 3 is very common. People feel like they're getting their principal back. Many investors have the mission of funding their startup ecosystem, and they want the money back to go fund the next deal. And so it can help your fund turn into an evergreen fund. I've had accelerators use this where they're actually using it to fund their accelerator companies, but since they're starting at pre-revenue, they're not asking for 3x, they're asking for 1.5, maybe 2x, something like that. Again, it turns their accelerator fund into an evergreen fund, but at the same time, it gives them an out in case the startup turns into a lifestyle business and doesn't go very far.
Okay. And Roberto is wondering if what you're saying is that this only works for angels, meaning would this not work for smaller early stage VCs?
You can work for venture capital. Some VCs are interested in having this out of it. In general, though, I find most VCs are looking for 10x returns on their investment, and when we get into 2, 3x, it's not that interesting. But in micro VCs, sub $100 million funds, I could see this being very helpful to turn your fund into an evergreen fund. You get enough back to go for the next fund. And so from that point of view, I think it would work. It would be helpful to have in some cases. But in general, especially later stage VCs, they operate under the power law. It's all about the winner of 40x paying for everything else. And when they have a salary baked into their fund, it kind of pushes the economics in that direction. Mm-hmm. But I can see micro VCs finding this a very useful tool to keep their fund going for the next round, even if the startup isn't going to exit anytime soon.
Okay, I think we move on to the next slide.
So Tin Capital, for those who are not familiar, many of you are in our program, some of you are not. The way we work is we're basically making investor introductions and running investor relations. We're not a broker. We're not raising funding for companies or what have you. We're not an angel group. We're really a group of investors that come together that want to see deal flow. And so what we'll do is qualify deals when they come to us, make sure they're in the game for venture funding, I call it, and then we'll send you an email with their deal in it, basically the pitch deck, and you have 3 buttons on there: intro, pass, follow. Intro means you want to talk to them. Pass means you're off this one, and follow means just keep sending me updates and let me know more about this deal as I want to see where it goes. And so we update you on a regular basis. Every couple of weeks, we send you an update about how the deal is doing. And then if you are interested, you perform your diligence. We'll help the company get their diligence box or data room together, so you don't make this a paper chase for you. And then you do your diligence and decide if you want to invest, and you invest directly with the startup. We're not a broker. We don't have a FINRA license, so we can't get in there and take success fees. So we don't do anything. We charge a monthly retainer to the company. For early stage, it's $14.95. For later stage, Series A and beyond, it's $2,500 a month. And most people in our program about 3 months. And so that's how we work, is we're helping startups reach investors, and we're qualifying and accepting deals that we think have value and are worth it for our investors as well. And a number of them are interested in 3x and 3. They come to us and they're interested in that. They think that that's a good model for their business. Some deals fit very well the venture model. It's a platform-based business. It's recurring revenue. It's SaaS-based, and they can capture venture capital funding pretty easily. But many businesses are not that. They have hardware components in it that's not always recurring revenue, and it's just the market realities are not always going to line up around venture-level economics. And so those deals are often happy to take 3x and 3 deals because they know they're just in a different place than some other companies as well. So We're not a fund, and there's no fee to join our group, but if you're interested in those deals, happy to share them with you and get your feedback on them as well. We have these sessions once a month where people come together to discuss how to invest and how to be more successful at startup funding. And we also have webinars where we have our companies come on as well, where you can actually meet their current investors as well as their team. So that's how our program works. If anybody has any questions, let us know. Glad to answer those as well. So we started this company in 2009 under the name Texas Entrepreneurs Network, and we're based in Austin, Texas, and focused on Texas for the first 7 years. And since then, our companies have gone on to raise $900 million since we started. We've had several 40x returns come out of our program over the years. And we have over 12,000 investors. That's including venture capital and family office and angels. They're all accredited investors. We are seeing a lot of crowdfunding deals come to us. We tend to be the first place to go to after they do a Title III crowdfunding raise or after family and friends. So we're usually a stop right after that when they come to us to go on. So you do get very early stage deals, and we do have Series B and C deals coming in. People with $5-10 million of revenue are also coming in wanting to raise money as well using the same model and the same program. So there's our email and our website. We have a tremendous number of educational tools. One of them is our e-guides. So if you go to that website, 10capital.group, there's a number of e-guides up there to look at. And if you're new to startup investing, we have a daily podcast called the Startup Funding Espresso. As we say, in the time it takes to have an espresso, you can learn something about startup funding. We've got hundreds of these that we've developed, and they're the ones that go to create the e-guides, but you can get on the daily email for that. You can either read it or you can listen to it as you drink an espresso. I'm very fond of espressos, but unfortunately they don't last very long. But at the same time, it takes maybe 1 to 2 minutes to actually read these. So I think it fits into our current day deal flow or workflow process where you have many, many things to do on email and otherwise. So who has time for a 30-minute read anymore? It can be tough. So we've broken it down into smaller steps for you on that. Any other questions you guys have for us at this point?
Yeah, we're going to open it up to Q&A. Kim Colt actually had an interesting question. Kim, do you want to go ahead and ask Hall?
Sure, thank you. I like the strategy of being able to have redemption rights early in order to kind of manipulate the risk reward, particularly if you think it's going to drag out for a long time before there's going to be an acquisition. The one concern I had there would be if they're in a place where they're raising additional capital and they're targeting, some venture capital funds, couldn't it be a deterrent for the VCs to be attracted to invest in the company? Because if they do, as kind of a validation of good performance, it would almost immediately, they would know that they'd have to kind of be in for the dilution associated with people not kind of exercising, and simultaneously, if the company was short on cash and needed that cash, the VC it almost makes the risk higher for them, because by not coming in, there's no dilution, but then there's the more likelihood that there'd be immediate exercise rights for people to get the cash out of the company, and it could hurt the company.
Well, you're right. And follow-on investors do not want to put money in to see it go out to previous investors. That's a real no-no, and a real tough thing to sell. Now, I will say that I've been in deals where we've had 5x returns and so forth, and the follow-on investors were happy for 2x the money to go out, but the investment, but not the entire 3, 4, or 5x in some cases. So there is a possibility they'll pay out something for previous investors. And again, you get into this trade-off where, the follow-on investors want the equity back. And so in some cases, they'll pay out a little bit. Like I say, 2x is what I've seen them pay in order to get that equity back for themselves. Especially at Series A, you want 20% or more of the deal. And if you have all these angels that hold on to the equity, this is a fixed price for how you get that money back or how you get that equity back. So there is a trade-off that goes in there.
Understood. And quick follow-up question there. Having actually done this and put it in the documents over time, do you actually see, what do you see happening when a VC later comes in? Do they renegotiate the terms, or do they get the founders to renegotiate the terms with the existing investors before they come in if they're really interested? Or do you see them see it and just back away because it's not worth their time?
In most cases, I see a negotiation go on. If they like the deal, they come in and they negotiate it. Can we
Okay.
get these guys to take 2x their 3 out of the 3x? Can we get them to take 2x in the form of payout so we get the equity back, and then the other 1x we'll do on a 3-year revenue share basis. Revenue share is very
Okay.
friendly. When it's just a % of revenues. So as revenues are high, they pay out. As they go low, it pays out. Usually it's 1, 2, 3% of revenue. It's usually not much more than that. And it takes usually 2-3 years to pay out something like that. 2x out of 3 is usually a 3-year window to pay it out. And
Wow, I've never seen a percentage of revenue payout. It's really interesting.
Well, that's called revenue-based funding, and revenue-based funding has been around for a while. It came out about 5-6 years ago as being a very popular thing. Lighter Capital and others came up with it. And the idea is some businesses just aren't going to be sold to, for 10x or 40x ever for whatever reasons. There are many businesses that are what are called family businesses. We're not going to sell the family business. And so how do you pay the investors back? Well, you're going to pay out basically 1 to 3% of top line revenue until you get 2.5 to 3x your money. And these are 3 to 5 year windows that you're talking about. And every month or every quarter, you get a check for how much that comes in.
Got it. Like a traditional business, almost investment versus a VC. It kind of mitigates the number 3 on your categorical list, which is the businesses that are just family businesses and not giving you returns for an indefinite amount of time. It helps to mitigate the loss on return on capital there.
That's right. So that's how you pay back on an investment you may have taken up front when you don't want to sell the business at the end of the day. And that's always a discussion to have. If you're taking equity funding from a venture capitalist, you're basically buying into their business model, which means we're going to sell the business in 3 to 5, 7 years for a large payout, and you're okay with that because that's where that goes. What we're doing is we're saying we're going to spend the first 3 years figuring out which way this is going. And then for the next 3 years, we're either going to be on the cap table as an equity investor, or we're going to start a revenue share program is what we're going to do, or a combination of those two. But at that point, it usually becomes clear what track we're on anymore. Are we still on the venture track? If this is the next Facebook, you really don't want to be doing revenue shares. You just don't know today what that is. But 3 years from now, you have a lot more clarity about that.
Thank you.
Sure. Thanks.
Paul, could you quickly go over what the tax treatment of this is?
So in convertible notes, there is an interest rate component, and technically investors who sign up for that should be paying a 1099 interest rate on it. I know a lot of people sign up for convertible notes, and with interest rates at 4%, it just never gets reported. So convertible notes are technically debt. And so if you ever convert, it is going to be at a debt level, but at the same time, after 3 years, you do have long-term gains on it. And so if you're converting with less than a year, that'd be ordinary gains. But if it's over 3 years, then that's going to be a long-term capital gains, which at this point are very low. We'll see where it goes in the next administration itself. If it converts to equity, same thing. You'll be on the cap table for a period of time, more than a year. And so you'll be paying in an exit there capital gains on it. One thing I will say is there are certain things like 1202 and other tax credits that are out there. Those are typically applying to businesses that are C corporations that have an equity or a Delaware C structure or C Corp structure, and they are going to be held for 5 years or more. This is a convertible note, not an equity structure. And so you'd have to have 5 years after you redeem or not redeem in order to get the 1202s. So you don't get a lot of those tax incentives. There's 2 of them out there through this structure. You give that part up. But at the same time, at year 3, you're getting returns in some cases at that point.
Okay. And any other questions? from the group?
I have one more if no one else does. This is Kim. If you want to bring opportunities to the 10 Capital Network, what is the process for doing so?
So if you have a company that wants to raise funding, you sign up a call with us, send us a pitch deck, and we'll discuss our program to see if it's a fit. We look for revenue. We look for companies that are up and running. It's really not for two guys with an idea. Our investors, angels, VCs want to look for what I call market validation, product validation. The product works and people will pay for it. So as long as you have some revenue, we have people that are in the game for it. If it's pre-revenue and it's two guys and we need money to get our idea off the ground, we find that very hard. And so we're not able to take many of those. Now, if it's FDA required, then we're really looking at your path through clinical trials for it. And then we'll discuss, if this is going to be a fit or not, and we'll sign you up. What we'll need is a pitch deck to kick off, and then we go out and start running the campaign. We do emails and webinars and Zoom calls to highlight the team and others to show this to the investors, and then set up calls where we can and go forward from there. So just send us a note if you have any interest in bringing in a deal, and we're glad to share with you. We do have some companies that are raising with a 3X and 3 structure. So if you're interested in that, we can put you in touch with them to learn more about the company. One thing we do with these companies is we write a diligence report. We go through and we state what's in their diligence box. They have this revenue, they have this intellectual property file, they have no debt, they have, whatever the situation is, we write up a report, and you can review those reports to get a high level understanding of where the business is and see what you think about it. And you're welcome to talk to the CEO. In fact, I always recommend you talk to the CEO. No matter what, talk to the CEO. Understand who you're backing and get to know them well, because you'll spend time with them on that. But glad to do this. The other thing we do is we offer 3X and 3, but we've had many angel groups come to us saying, yeah, those are nice deals, but can you put 3X and 3 on my deal? And the answer is yes. We can come and write the diligence report and put a 3X and 3 structure on your deal if you have a syndicate or a network or what have you, and we'll do that. And then we can help with the facilitation process if you want that as well, where we do the access to the bank account and the reports and so forth. Some cases the investors are doing that themselves, in other cases they want us to do that. But I think that's a key part to really understand what's going on in the deal also. Cool.
Right.
Any other questions there?
Yeah, just a couple others. Roberto is wondering if we get many startups applying from outside of the US.
We do. We've had deals from UK, Northern Europe, and Israel come through our program. I will say we do have investors in Europe right now and Israel. It's the vast majority. If you're in Europe, you need to raise from European investors. If you're from Israel, you need to raise from Europe and Israel. It's just too hard to be in one continent and raise in the other. You have to come here and have a presence. And we do get that. People open up a Delaware C in the US entity with the idea of accessing the market to sell their product, and then they want to raise funding in the US. That works. If you have somebody in the US, you can raise money for your international company. And there's usually a long-term vision of moving the operation to the US long-term for tax reasons. So we can work with internationals if that's your pathway going forward.
And I think we can call this the final question. Unless anybody else has a last one, I think this will be our final one. Are there any industries that 10 Capital won't work with?
We work with all industries that are in the venture model. We do have people that look for capital, venture looks for capital efficient deals. And so we once had someone bring us a combustion engine that was the size of your house. And we just didn't see that as capital efficient. So I will say that there's some industries that are probably going to be outside the range of venture funding, and it's really private equity or it's debt or something else that we may not be able to take on. But fundamentally, any deal we'll look at that is in the venture space that people will go after.
Okay. Well, thank you so much, Hall, for that information. To our attendees, thank you for joining, and thank you for the great questions. We will follow up with a recording of this so you can review the information if you'd like. If you did not have a chance to jot down Hall's email, we'll send that as well, along with his Calendly link if you'd like to set up a call. And again, thank you so much. We appreciate everyone being here.
All right, guys. Thanks so much. Have a good one.
Thank you.